Hello, let's make a brief study on SIX. This is the chart since the IPO, which was back in 1994. And the stock has been bearish over the long term. As you can see, it is below its IPO price more than 10 years ago. And this is the medium chart. The stock had this nice ascending trend here, but then it collapsed to below $5 after this big gap down here. Actually, the gap wouldn't close here at $6.93. I see now it would be at more than $7. And recently the 50 days moving average crossed above the 200 days moving average, which gives some hope to chart readers. And it looks like the stock is trying to make a long-term bottom here, a rounding bottom. And well, as you can see, it has been trading sideways. It tried to break out here, but then the business update the company gave didn't please investors, so it came back down again. And so there's no trend on this stock. Technical analysis is neutral, but if we consider the long-term trend, well, it is more bearish. As for the fundamentals, let's check them here using my valuation model. Let me try to give you a very brief explanation of how this works. Well, I make four estimates, which are these white lines: the dilution factor, the revenue CAGR, what I expect for the next 3 years, the net profit margin estimate, and the earnings multiple estimate. These yellow lines are known facts, and these dark yellow lines are calculated by this model. We have an initial share price of $6.25, which is Friday's close, a share count of 94.68 million shares, and I expect the share count to grow about 1% per year for the next 3 years, because that's what it has been happening. As you can see here, there was a lot of dilution until 2000. Look here, the share count grown, not a lot, a bit of dilution, and here in 2001 when the share count rose from 80.1 million to 92.4 million. But since then it has remained fairly stable, rising about 1% a year, so I expect this to continue. Even though the balance sheet is quite weak, you can see here long-term debt is $2.4 billion and current assets are just above current liabilities, which means the current ratio is about 1.15, and I like to see it above 2, so the balance sheet is weak. But just 1% dilution expected going forward. Okay, moving on. This gives me a final share count of 97.6 million. Initial revenue. This is the revenue the company had over the past 4 quarters. It was $952 million. And I expect revenues to grow. Well, this is a bit of an optimistic scenario, 5% a year going forward. I mean optimistic because revenues were not growing. Let me try to put this here. Well, they've not been growing. This is SIX. Okay, if we go here to the income statement, you can see that there's no revenue growth. Revenues were 1.03 billion in 2002, 1.2 billion in 03, 1 billion in 04, and just 945 million in 06. So there's no revenue growth, but I put here 5% growth because that's what we've had over the latest business update. Let me check that again. Where is it? Provides business update. Okay, there was 5% revenue growth here. Total revenues increased in this quarter through June 3, 2007. Total revenues increased 5%. So, well, I put here that will continue, 5% revenue growth, which gives me a final revenue for 2009 of $1.1 billion. Initial net profit margin. This is the net profit margin the company had in 2006, which was a negative 21.8%. I expect this to improve and the company to be profitable with a 3% net profit margin 3 years from now, but there's no assurance of that. It can be more or it can be less, but the history tells us this is an unprofitable business, at least until now. And this gives me a final net income of 33.1 million and earnings per share of 34 cents. If we consider the industry average earnings multiple, which is 24.15, let me check that here. 24.15. Yes, this is the general entertainment industry, which trades at 24.15 average PE. So I've put that on my model, and computing all this, it tells me the share price will be about $8.18 3 years from now, which means a share price compound annual growth rate of 9.4%, and I look for at least 16%. So the stock, which is double the market average of 8%. So the stock is not attractive. I'm not saying it will go down, but it won't outperform the general market in my view, so I consider it not attractive. On a 1 to 10 scale, I give it a 6. Thanks. Bye.